class, and welcome to our last chapter, Financial Economics. We're going to talk about investments, present value, different types of investments in return, the notion of arbitrage and risk, how do we compare risky investments, and finally the security market line. This is really good information if owning stocks is something you do or are planning on doing, or investing in the markets. So economic investment in an economic sense is simply additions or replacements to capital goods. So if a business buys new equipment, that's a form of economic investment. Financial investment is probably what you think of when you hear the term investment. That's buying things like securities, stocks and bonds, financial or real assets, so I buy gold coins or real estate. They could be new assets, old assets, buying or building an asset to try to make financial gain. It's broader overall than economic investment. Now, money, as we know, has a time value component to it. And what this means is the amount you make must compensate a person for having to wait. Money now is generally worth more than money in the future due to the notion of inflation and money losing value over time. And interest that we get on money is generally compounded. You earn interest on the interest, and that's why when you make investments, you generally gain a lot more than just the stated rate of return. So X dollars today is equal to 1 plus whatever the interest rate is to the T power, depending on how many years we're looking at. So $100 today, we're earning 8% interest. After 1 year, we'll have $108. We earned 8%. But in 2 years, we're going to earn more than another $8 because we're earning 8% on 108 and not instead of 100. So instead of 116, we have 116.64. We earned 8% on that additional $8. So we're now getting more money than we did. The third year, we're now making 8% on the 116.64 and getting 125.97 instead of 124 if it was just $8 per year. So the more years that money gets compounded, the more and more it's going to grow. And if we look here is $100 at 8%. After 17 years at that 8%, we would have $370. So compounding starts to grow geometrically. So if we want to find the present value of money and calculate what we should pay for it today, here's what we would do. X dollars today equals X dollars in T years, so we take X and we're going to divide it by 1 plus the interest rate we would earn times the number of years. So if we have some sort of investment that is going to pay us 8% for, let's say, 20 years, what should we pay for it today? That's how we're going to calculate this. So the lotto, for instance, if you win the lottery, you have two choices. You can take the full value of what you win. So let's say you win the Powerball, you win $800 million. You could take a series of payments over 20 or 30 years, whatever the terms are, or you could take the lump sum. But the lump sum is a lot less than the $800 million because they're calculating that if you waited for all of those payments after all of those years, what would the present value of this be? You could do all of this in Excel as well. The function is equals PV or equals present value, and you can input your information that way as well. So things like salary caps and deferred compensation, we can calculate the value of deferred salary. Deferred salary is salary that will be paid in the future as well. So popular investments. If you choose to invest your money, you have almost an unlimited choice of what you want to put it in. You could buy all sorts of stocks, bonds, mutual funds, cryptocurrency, physical assets, digital assets. The list is almost endless. But for something to be an investment, there needs to be three things in common. Number one, an investment you must pay to acquire, whether or not we buy a Bitcoin, or we buy shares of stock, or we buy a silver bar, or we buy part of a commercial building, we're spending some sort of asset to acquire it. It's usually money, it could be other things, but we have to pay something to get an investment. There's always going to be a chance to receive a future payment or some form of growth. And there's always some risk in investments. There is no such thing as a completely risk-free investment. We say that government bonds are riskless because the government's never defaulted, but nothing is truly riskless. So there's always some form of risk in your payments, in getting your money back and your money growing. So stocks, and most people here should be pretty familiar with them, they represent ownership of a company. If I buy shares of Microsoft, I technically own a very small portion of Microsoft. That's what stock shares are. But companies can go bankrupt. They can collapse. Your stock can become worthless. Now, stocks do have limited liability in the sense that if I own shares of Microsoft and they commit some giant fraud and go out of business, I'm not going to lose my personal assets. The worst I could lose is the money I spent on those stock shares. That's what we mean by limited liability. So you are protected when you own a stock from being sued personally if the company does something shady or illegal or some sort of scheme or scam, but you could still lose a large amount of money. Anything you make on a stock is known as capital gains if the stock goes up, and dividends are payments from the company if they make profits. So a lot of stocks pay what are known as dividends. So every quarter or every year, depending on how it's structured, generally quarterly, the company is going to pay you a certain amount of money per share that you own, and that's them taking some of their profits and paying them back to their investors. Bonds are debt that you can buy. So if I buy a bond from a company, I'm lending them money. So they're usually denominated in $1,000 increments. So I give a company money, they're going to use it to operate with, and then pay me back my money at some agreed upon rate of interest over a certain amount of time. Bonds, however, are not riskless either. There's a possibility of default. Default meaning the company cannot actually pay back its bonds, and in which case the company would go into bankruptcy as well. So you can certainly lose money on both stocks and bonds, but the reason we buy those things are stocks we expect to grow and or get dividends. Bonds, we receive regular interest payments. Mutual funds, if you choose to invest in one of these, it is a fund that owns a whole lot of different stocks and bonds. The reason mutual funds are attractive is it allows you to invest in many, many things at once without having to individually buy them. The fund manager is going to buy stocks and bonds in certain fields. So it could be in technology, or it could be in large cap companies or small cap companies or pharmaceuticals or international stocks. Whatever the mutual fund is focused in, it's going to own a whole portfolio of stocks and bonds in that field. And there are different kinds. So actively managed funds are constantly buying and selling stocks, and they have fund managers. Passively managed funds, much less so. They just hold a portfolio and very seldom change. And index funds track the indexes. So the Dow Jones, for example. You can buy a mutual fund that owns every single stock that makes up the Dow Jones in the same weights. So in theory, it should perform pretty much exactly like the Dow. When the Dow goes up, you'll go up. When the Dow goes down, you'll go down. There are ones for the Dow, S&P, NASDAQ, all of the international indices as well. And here are all different kinds of mutual funds. These were the largest as of the end of 2021. And note, they have hundreds of billions of dollars under management. So how do we know how we did on our investments? Well, if we make investments, gain or loss is stated as a percentage rate of return. And it's simply the difference between what we sell the asset for and what we bought it for divided by the purchase. And any future series of payments are also considered into the return. Rate of return inversely related to the price. If something's going to return a ton of money, it's probably going to be pretty cheap to buy up front because most of the value is going to come from future payments. That's what we mean rate of return inversely related to the price. So what's arbitrage? Arbitrage is buying and selling to equalize average returns. So if we sell an asset with a low return and buy one with a higher return at the same time, eventually both assets will have the same amount of return. There are periods where you can take advantage of arbitrage opportunities, but markets are very efficient, and with digital technologies even more so, so they're generally pretty fleeting. Now, what about risk? What if I told you I can give you a choice of investments ranging from very low risk to very high risk? What ones are going to yield the most return? Risk and return are directly correlated. To get investors to assume large amounts of risk, you have to offer a greater return. Now, future payments in general are uncertain. There is always risk in any form of an investment. The best ways to offset that risk is what is known as diversification. And diversification is purchasing a large portfolio of different stocks or bonds or some combination of both, or different types of assets, so that if even one goes down, many of your others may go up or be stable. So a diversified portfolio is a portfolio not just in one thing. And diversifiable risk is specific to a given investment. If you only have all of your money in one stock, you have a tremendous amount of diversifiable risk. Once you increase your portfolio size by enough of a margin, you can get diversifiable risk very, very low. Non-diversifiable risk is something we cannot get rid of, however. What we mean by business cycle effects are things like economic contractions, recessions, unforeseen shocks. No matter how well diversified you are, that's always going to be risk that exists. But don't put all of your money into one asset, or one investment. That's a very poor strategy. The reason being, you're leaving yourself open to a lot of risk that can be diversified away. So international differences in risk here. So if we look, the higher the rating, the less risk, or the safer the economy. So really, unstable countries, Somalia, Syria, Liberia, very, very risky. Switzerland is the least risky economy currently, or as of 2022, I believe this data is from. So when we're comparing risky investments, what can we do? Average expected rate of return is what we would expect to earn on this investment. And a probability weighted average is we can look at various scenarios and weight what we would earn in those scenarios. So let's say there's a 20% chance an investment does great and we make 20%, a 50% chance we make 10%, a 10% chance we lose money. We can calculate all of that and come up with a probability weighted average, or our average expected rate of return. Investments have also what is known as a beta term. If you look at stock quotes online, it will give you this beta. You could also calculate portfolio betas as well. If you take financial management with me, we're going to go much deeper into this in Management 1003. But beta is a relative measure of risk. The overall market always has a beta of 1. So a stock with a beta of less than 1 is less risky than the overall market, or some form of an investment. An investment with a beta greater than 1 is more risky. So it compares your risk to the risk of the broader market. So a stock with a very high beta, 2 or 3 or something like that, you're going to want to expect a much higher return to be okay with taking on that amount of risk. So risk and expected rates of return, once again, are positively correlated. The riskier something is, the more return you're going to expect from that investment. What we would consider risk-free or virtually so are U.S. government bonds. The U.S. government has never defaulted on its debt, so that way if you buy things like U.S. Treasury bonds, bills, things of such, they have much lower rates of return than other investments, but they're very, very, very risk-free. They do offer a greater than zero return, and what we mean by time preference is the longer the duration of the government security, generally the more rate of return. Overall, except in certain situations it can flip, but overall, the longer the duration of an investment, the more return you're going to demand due to time uncertainty. We don't quite know what is going to happen to the U.S. government's finances in 10 years, but we could probably be pretty certain the government's not defaulting on anything in 3 months. So the more time, generally, the more return. And we consider government securities, once again, a risk-free interest rate because to date, the government has never defaulted on its debt. So we have to compensate investors for both time preference and risk. So as risk is going up, rate of return is going up. As time is going up, once again, rate of return is going up as well. So we have to compensate investors for generally both of those things. Now, what are we looking at here? We're looking at what is known as the security market line. So our risk-free asset, like a U.S. government bond, has a much lower rate of return than the market portfolio, which is riskier. And then as we get riskier yet, note the rate of return is climbing. So the market portfolio has a beta of 1, and the riskier we get, here's our risk premium. So your average expected return is both a combination of compensation for your time preference and risk. The more time, generally higher return. The more risk, higher return as well. And here's an example of arbitrage. We have two different assets at the same risk level. One has a higher rate of return than the other. And once again, these opportunities are generally fleeting because once recognized, the returns will balance out at the same risk level. But if you do wind up in a situation like this, obviously you would much rather prefer security A, which is just as risky as B and C, but offering a greater return than either. What about if interest rates change? If interest rates change, the security market line itself is going to change, just like the curves we've seen in this class. The whole line is shifting up. Still, as risk is increasing, rate of return is increasing, but overall the rates are higher because interest rates in the broader economy went up. So during COVID, the security market line, what happened to it? The Fed expanded the Fed did expansionary monetary policy. We covered this last chapter. They expanded the money supply and interest rates dropped. So the SML shifted downward, but the slope increased because investors got scared. During bad or shocking economic times, people become risk averse. So if I'm going to take on something really risky during COVID when it looks like the whole world's coming apart, I'm going to want a tremendous rate of return to accept that risk. So the slope of the security market line went up quite a bit. The riskier something got, returns went more and more and more. And since people got so risk averse, stocks overall fell. Generally, when people are risk averse, they do not want to invest in stocks. And finally, index funds versus actively managed ones. Let's say you want to put your money into a mutual fund. You have a choice. Do you want active management, meaning there are one or more fund managers that are constantly tweaking the investments? Or do you want something passively managed, like a Dow tracking fund? So after costs, because actively managed funds generally have fairly high costs to pay the people managing it and all the transaction fees, a lot of index funds have actually outperformed the actively managed ones. Management costs are significant. But index funds can be boring. There is no chance to exceed the average rate of return. If we invest in a fund that directly tracks the Dow, we should return basically what the Dow does. We're never going to beat it. Whereas if we have a feeling and we decide to go with an actively managed fund that you think is being run by someone really smart, you actually do have chances where, at least in the short term, you can beat the broader market. So, as I will say to end on, when you go to make investments of your own, whether it's stocks or bonds or assets or mutual funds, do your due diligence, do your research, make sure you are diversified and don't have all of your money in one place. And certainly look into whatever you are going to invest in. So that's going to take us to our last slide of our last chapter, and I really hope you enjoyed our course.